Here we go. Welcome to our 2019 kickoff event. It's thanks for shuffling around with us. We had a bit of a ice storm at the first one, so I appreciate seeing all these familiar faces in the room and you guys taking the time to be here. I know everybody's got a busy schedule, so really appreciate you guys taking the time to be here a second time. Hopefully we'll have some good information for y'all. Don't forget to pick up these really juicy legal disclosures to take home and read. Debbie has those for each and every one of you. But it was just a short year ago, the agenda today, so we're going to look at obviously what's happened in the markets. We're going to take a look back. We're going to take a look at where we are today. We're going to take a look at specifically how our managed portfolios have performed during the good and the bad that we've seen of late in the financial markets. We're going to spend some time on an area that we titled up here, how important it is to distinguish between fact versus fiction. There's a lot of myths, that get floated around out there on the internet or by friends and family or the media, and we're going to talk about some of the most common ones that we see continue to trip investors up. And the whole goal of that and really every one of these meetings is to help you guys help you make smarter decisions to make the most of your one financial life. That's really the only reason we exist, and we'll finish, like I said, with a Q&A. I thought I'd just bring this back up, and I'm going to need my notes for this, but it seems like forever and a day ago, but these were the numbers when we were in this room for our kickoff event last February. That would have been February of 18. Those were the numbers we were looking at as we look back on 2017. And it seems like forever ago that we saw numbers that nice. And I pulled this out just to, and what we talked about then, and I'm going to quote this. If there's one thing that we must all recognize, it's that investing rarely gets as good or as smooth or as easy as it was so easy to make money in 2017. And it kind of, I know it's made us a little bit spoiled, and it's very dangerous when we get spoiled like that because it leads to some of the things that Scott Bosworth, who was our last guest speaker, talked about on behavioral issues that are very human nature, like overconfidence or complacency or what. In any event, we all know that 2018 has been a really good tutorial for the fact that markets bounce around, markets move around a lot. What we saw in 2017 would be what's on the left of that picture, and what we're experiencing. What we experienced in 18 and this year, volatility, big swings in the market are really more common than the synchronized, smooth increases that we saw in 2017. Markets are volatile, and that word volatility sometimes scares people, but we saw it was volatile, both good and bad, really for the first 3 quarters of 18, and then of course the last quarter of 18 was nothing but bad. Let's just acknowledge that. That was painful and it was unpleasant and all that. And then the day after Christmas, volatility came back, but it went to the upside. No one seems to mind that, but we'll go over all that, we'll go over all that kind of stuff. But these are the numbers that we saw in 18, the U.S. stock market. And if you really try to put it into context, I don't want to mask the fact that it was painful, but look, we had a huge year. U.S. stocks were up like 20% in 17. They gave back 4%. International stocks and emerging market stocks were up 25% and 35% respectively. It's painful, but it's not too surprising, really, to see the markets give back a little bit when they had such a stellar year in 17. Real estate didn't do that great with a -6. This is the first kind of fact versus fiction distinction that I wanted to make. How many people in the room have heard, hey, this is just the way it works. When interest rates go up, bonds go down? Come on, some people in this room heard me say that 30 years ago. I mean, I'm a work in progress too. So it's just not always true. You know, the Federal Reserve raised interest rates 4 times in 2018. Did bonds lose money? You know, and if you look back at all 5 interest rate increasing periods that we have on record, I mean, it's not even a coin flip. Bonds have made money in 4 of those past 5 interest rate increasing periods, and stocks have made money in all of them. So there's so many factors that affect the markets, and a lot of times these real simple, you know, the older I get, and I'm sure you guys will agree, the more I like simplicity, but markets are really not that simple. There's millions of factors that could affect, you know, what happens. Just interest rates going up or down, especially the Federal Reserve. The Federal Reserve really just has control over short-term interest rates, so they really can't affect in any event, these short, simple rules of thumb oftentimes are not all that, all that reliable. It's nice to have a marker, but in any event. Okay, so let's have a little bit of fun today. Let's do a pop quiz. So this is for a $100 gift certificate to any Howell restaurant, anywhere, you know. So for $100, only one country's stock market saw a gain in 2018. For $100, can somebody tell us what that was?
Greece.
Somebody else?
New Zealand.
Somebody else? 10, 9, 8, 7, 6, 5,
North Korea.
4, 3, 2, going once. Man, I really want to give this $100 away.
United States.
Canada.
What? No. Okay, let's flip it. So this just shows why it was Qatar. Oh, you said Qatar? Debbie! We have a winner. Qatar.
Who said Qatar?
Oh, okay. Damn it.
I like no one will guess that.
Okay, so in any event, if nothing else, I wish I could have given away that $100. I think that chart shows that's every major stock market in the world, and the only place that made money was Qatar, which is borders on Saudi Arabia, and it made a whopping 27%. Not a bad return, you know, for anywhere. But if you look at everything else was red, and that just shows how difficult it was to make money anywhere. You know, investments in general just really, you know, had a tough year this year. But just as, you know, maybe tomorrow, I think I was talking, Gene says he may go fishing tomorrow because it might be warmer. Things get better after they're really bad. You know, that's the way markets work. You know, the sun comes after the rain and so on and so forth. So we're going to talk a little bit about that. But yeah, Dennis, if you talk a little bit about our portfolio returns.
Yeah, so with those great numbers, let's see how our portfolios fared last year. On the far left, I know it's kind of small, but I'll read it off to you, is how 4 of our more popular portfolios fared last year. You see at the top, our 40% stock, 60% bond mix had a decline of 3.8%. The 60-40 mix, which kind of gets into where maybe more of you are in that 60% stock, 40% bond mix, had a decline of just right at 6.5%. 75% stocks down 9%. Our most aggressive was down 10.5%. But what you see up here, again, these are our actual returns and clients in these portfolios over the past 20 years now. 20 years returns, net of all fees. And so I wanted to look, instead of just this year, what's happened over the past 20 years. So if we blow that up, you look at, you know, this is kind of interesting. Over the past 20 years, the U.S. market's only done a 5.5% return annually, about half of what it's usually done. And international hadn't even done that well. It's only 3.2, so about a third of what it's usually done over the past 20 years. But what we're really proud at, we're going to talk about how it's important to stick with your plan and stick with your investment philosophy. Just by doing that, for those of you who only had 40% in stocks, so you're taking 60% less risk than the stock market, you barely outperformed it. 5.6 versus 5.5. So with a much less risk, you got stock market returns over the long run. And then 5.7 with the 60-40, 6% with the 75. Our most aggressive 100% stocks, 7.5%. So we're outperformed. We're not trying to beat the market, but by not trying to beat the market and sticking with our plan, we beat the market. All right, and so 2% may not sound like a lot, but if you invested $1 million in 1999, January 1st, 99, this 20-year time frame, the S&P with this, 5.5%, you have 2.9 million, which is still good money. But with a 7.5% return, having 2% more a year, it grew to 4.2. 45% more money just having that 2% more each year. So, you're always hearing us talk about 0.5% here and 1/4% here and this and that. It adds up. It adds up fast.
Dennis, I'm sure I'm the only one in the room thinking this, but what about our fees out of these numbers?
That's after fees, net of all fees. Net of our fee, fund costs, trading costs. These are actual returns seen by clients over this time frame.
And I think everyone in here knows that anytime we show rates of return, they're always net of all fees. Anytime we're doing a financial plan for you, a cash flow plan, it's always net of all fees. So it's, it's what you can take home and spend, which is all that really matters.
Right.
That's true. So we saw, let's look at a 60-40 portfolio. Again, that's kind of, if you look at everyone as a whole on average, we're 60 to 70% stocks. So I just want to look at a 60-40, 60% stock, 40% bond mix. These are the returns and the asset allocation. I just wanted to look back 30 years. I mean, last year, this did, as I said before, we had a 6.5% decline. If we go back 30 years, there's been 2 years where it's, everyone remembers that one, of course, 2008. But there's been 2 years over the past 30 that have been worse than last year, which really isn't too many. So, last year wasn't terrible, but it's one of the worst ones we've seen. But what we wanted to really have you point out is if you look at like 1990 here, it's about the same. But what happened the next year, and the next year, and the next year, and the next year? And then you had another big decline. What happened the next year, the next year, and the next year? So when we see these declines, usually what happens is we see good returns going forward. We're not predicting that by any means, but that's usually what happens, all right? And so if we just look at the first 2 months of this year, lo and behold, that's happening again. It's happened, January was a really good month. And so after having that, really tough fourth quarter, it bounced back pretty quick. You see that, U.S. we're up 12%, a little over 9% in international, 10% in emerging markets. Real estate's up almost, 11.5%, almost 12%, which is a really quick move for real estate. And then, U.S. bonds are up 1%. If you remember, we've switched to a little more of a global portfolio for our bonds. So the global, we're about 3% up for the year for what you guys own in your bond portfolio. What's that?
It says 2017 instead of 2019.
No, 2019.
Oh, run the chart.
Oh, yeah. That's my bad. I didn't take that out.
Call a screw up.
Yeah. Thanks a lot, Frank. That's my fault. Thanks, Frank. I just updated it with 19 numbers.
We put this together at about 2:30 in the morning last night.
Come on, $10 gift certificate.
Yeah.
The Colonel. Nothing gets past it. I mean, I love this group because it's like I walk in the room and I get all nervous every time we do one of these because we've got, colonels and doctors and, root canal doctors and successful people in all areas. And it's like, you think you're going to get away with anything? You're wrong.
I was like, no, it doesn't. This has 19 right there. Like, no.
We're going to talk a lot about strategy, but Dennis just sort of went over the analogy I like right in front of you, and I know you guys look at this, you're like, I'm not going to read that again, but we have updated it. It's hot off the press for a couple of tweaks that we've made to the portfolio. You guys may or may not recall. I think it was, our Kickoff Event February of last year, we talked about the fact that we had included a new risk dimension in our portfolios, the high profitability dimension, and that's explained in here. But this is our, this is our game plan. If this is like if this is football, what Dennis went over just a minute ago is the scoreboard. But the numbers don't have, and the results matter. They matter a lot, and we try to, and we're a little, we really take pride in putting those numbers on the board. But we don't do it by winging it. This is the playbook. This is the playbook we follow in good markets. It's the strategy in bad markets. I had a new client text me one time 2 or 3 years ago, and he's like, "Hey, what's your bear market strategy?" I'm like, same as the bull market strategy. We're going to run the strategy. We're going to run the strategy. We're going to go out there. We're going to say the ball lies here. Even if it's a bad lie, we're going to run the strategy. So I'd really encourage you guys to read over this. About half of it is graphics or pictures. I think it does a pretty good job of explaining our strategy in plain English. And if you get home and you read and you're like, well, I don't understand that, or that doesn't ring true with what maybe we talked about before, get us on the phone. I mean, we are always eager to be helpful. So we're an email or a phone call away anytime for any reason. So, but if you would please, I know that I was joking around a little bit. You probably should read those legal disclosures, but this is what you really ought to read. I mean, this is what we're really doing with your hard-earned money. So.
I'm not supposed to ask questions, but is this from where you are in Florida? Would this be like?
No, I don't even know. I think that picture is, I think it might be the lake right by Chicago. I don't even know the name of it. Lake Michigan? I don't know. So, it's just a pretty picture, Kathy.
One thing you'll read in there a lot, and you've heard us probably say it a lot too, is we're all about having your portfolios really diversified, ultra diversified. Diversify your money across different asset classes, a lot across thousands of different stocks and thousands of bonds and things like that. So then you get your statements and you see, okay, I'm in DFA US Core, and so I kind of wanted to go over, we haven't done this in a while, is, okay, what do you own in that? And kind of show you how diversified your portfolios actually are. So here you see that left one is the top 20 stocks you all own in your portfolio out of 13,773 stocks is how many you own. And on the right side are the top 10 bonds out of 1,307 bonds. So you own over 15,000 stocks and bonds. And once in a while we'll hear someone say, I'm kind of worried about, what if I lose all my money in the stock market? I'm really worried about that. We're retired and we need income. So I kind of want to give you an idea, put money to it on how diversified they are. So if you look at this top 20, let's say we wake up tomorrow and in the news is Apple said, you know what, we're not making iPhones or computers anymore. We're out of business. Gone. Zero. Microsoft just happens to be the same day to say, you know what, we don't like making computers either, we're done. Based on that, Amazon's like, well, if no one's on a computer, we're out of business too, so we're out. All right. Then Verizon's not going to be around anymore because Apple's not making iPhones, so they're out. And then Samsung, believe it or not, now they don't have a competitor, but they decided to go out. And so on and so forth. Cell phone towers, Visa is not going to be in business because Amazon's not in business anymore, and no one's going to take care of their houses anymore, and no one's going to use a bank, and no one's going to a mall, and no one's using drugs, and so all this happens in one day before we can sell them. They all go to zero. Wow. All right. Yeah, just immediately they're gone. So if we had $1 million and you had it 50% stocks, 50% bonds, let's say, at the end of that day, your stock portfolio would be down $38,000. That's how diversified it is. The top 20 largest holdings are 38,000 out of $1 million. And it just gets smaller after that. Same thing on the bonds. If those top 10, Procter & Gamble, U.S. Treasury, those 10 went out, it's about $50,000. So the top 20 largest companies in the U.S. and the U.S. Treasury and all, some European and U.S. companies go out of business, you're down about 80,000. I get it, there would be other, something else is going on, but you kind of get the picture on how diversified it is. But just to show you, these are your largest holdings, and if those went to zero, you're down about 8%. So that's how diversified the portfolios are.
Oh, no.
Did they break?
So, no, I mean, there's some people in the room that have been around when I started this. This is going to be like a kind of a personal story. So I started in this business in 1987, and some people started with me not too long after that. And I had this strategy back then, and a lot of people feel like that, they can, if you find the really smart guys, like the ones that are on CNBC in the morning, and, they all have these awesome looking ties and suits, and everything they say is, intelligent. So I thought, well, okay, here's the way I'm going to go about this. I'm not going to go to work for any big Wall Street brokerage firm, and for the record, I never have. I hung out a shingle and I said, I'm going to go find the really smart guys. And man, I went everywhere. I mean, I went to New York City, I went to Boston, I went to, I can't even count the places. I went to Chicago, I went to Ohio, I went to Miami, I went to Georgia, I went to Atlanta, I went to Rome, Georgia. I went to, I don't need to go. I went all over to California, LA and San Francisco, and I spent so much time and money and energy and time away from my kid and my wife looking for the really smart guy. Because I just thought that if I could find the really smart guy that could predict where the market's going or where the economy's going or the right stocks to be in and all that kind of stuff, that everything would work out splendidly and my clients would make a lot of money and my career would be great and all that. And I don't know how I could have been so finally it just dawned on me that all this has to do with my belief that someone can predict the future. That's just ignorant. How did I even believe that line of reasoning? But it's still so prevalent today. The media is powerful. And the media, gets paid a lot of money in advertising from the big marketing machine of Wall Street. And they want you to believe that their really smart guy or gal knows where the market's going next. And it's just, finally I'm just like, I think those ladies and gentlemen put their britches on the same way I do. I don't see how it could be that much different. And so, what we've done is, and it's all in here and this, is that then finally we caught our senses and we're like, we said, okay, let's just kind of practice rationality under uncertainty. Let's just recognize that nobody's got a crystal ball, or if they do, it's cloudy, and let's build our portfolios based on the latest academic research coming out of the leading business schools, just like the pension plans do, and diversify. And I know it's boring, and I'm sorry, but it works. And every year, these really smart guys will go on, and they'll go on record. I think I put a little chart up here, Dennis. Yeah. And look at this. They do this every single year. They'll come out and they'll say, here's where we think the market's going this year. And these are the top, these are the top firms in the world. And so here's 14 of them, and 14 out of 14 of them were wrong, and 13 out of 14 of them got the direction wrong. We all know that the market went down without dividends. The S&P 500 went down 4%, and on average they predicted it would go up 4%. The really smart guys and gals, they may be really smart, but they can't predict the future. So it's so important to recognize that and to put some of these comments you see. They may be really intelligent. They may make a lot of sense, but they still don't know where the market's going next. So that was a big lesson that I learned, and I learned it the hard way. So
Here's who can help, the media, right? They can help you. So the other fiction is the media is here to help you make smart decisions with your money. So, there's really smart people in the media. There's some smart people in it. But you got to remember, their job is, especially the financial news and financial magazines, their job is to get you to watch 24/7 and sell ads, or to, if there's something online, to get you to click it. The more times someone clicks it, the more money they make. So the more out there the headline is, the more people they're going to be like, oh my gosh, that's, I got to read that. That might be really important for me to know. So these are just a few of them. A famous one back in 1979 was the death of equities. We all know that didn't happen. is how get out of the stock market. They're not going anywhere from now on. And you look at, Fortune in 1998 is telling you that's the crash of 98, and 1 year later they're telling you retire rich. It's simple. Same magazine, a year later. So these are a little older. I want to look at something a little more recent to show you I think it's even getting worse, really. So let's say you wake up, December 1st in the morning, Christmas is coming up, it's cold like it still is right now. Seems like it's been cold for 6 months now.
Yeah.
But you grab your cup of coffee, you turn on your computer at 6 in the morning, that's the first thing you see. Read that headline. I don't know how many scary words you can put in a headline, but that might be a record. That's the first thing you read in the morning. You're like, wow, recession, crisis, bracing for meltdown. That's a lot of bad stuff right there. So you're kind of like, wow, Brian and Dennis, they haven't said anything about this. What's going on? Well, maybe we're all right. And then 11 days later, Molly Fool's here to help you out. They're like, well, here's a plan to survive the stock market crash. You're like, all right, well, I just read about one 11 days ago, so there's something going on here. The next day, you read this. You remember this. This is, stock market, it wasn't pretty. December 17th, the trader's looking, they always have the trader that looks really worried on the floor. They're like really, really scared. And, we're on pace for the worst December since the Great Depression. They love putting since. It's since this or since that. They got to put a since something in all the time. So you're like, well, I'm going to stick it out. They said it always comes back. Christmas Eve, this happens. Okay, you're like, is this going to stop? It just keeps getting, I read 24 days ago or 23 days ago that one horrible headline kind of told me this was going to happen, right? And my favorite on this, I don't know if you can read it, on the bottom it says, it was brutal, a brutal Christmas Eve at the New York Stock Exchange. And there's someone walking their dog, and there's someone in an umbrella. It's brutal out there, right? So how are you feeling right here? It's been bad. Prepare for this, a stock market crash and all. You're like, okay, I can't take this anymore. I'm going to get out. Yeah, if you do, sure enough, next day, bam. Now the trader's excited, right? It's the best day in 10 years. All right, is it a fluke? I don't know. Yeah. Well, let's go the next day. Hey, there he is again. Same guy. He's high-fiving again. I think they're kind of using pictures. Have you noticed that? So 2 days in a row, now we got 1,000 points, the biggest single day gain ever. These 2 days, it went up 6% in 2 days. The U.S. market did. If you look back over the past 20 years, there's 9 years the S&P didn't do 6%, and for the year, it did it in 2 days. So you hear us talk a lot about, it happens fast. It happens when you least expect it. This is a good example. So, here's 2 days in a row. We're thinking, well, now I don't know what to think. Well, there he is again the next day. Same guy. Now it's wobbling and it's turbulent again. It really didn't do anything. So now I don't know what he is. All right. So now you're like, well, I don't know what to think. It's gone all over the place. Well, now the camera's got wobbly along with the stock market. Now it's all over the place. Now they're telling you about financial crisis of 2019. And if you look down here, it says that feeling when all the numbers are so bad. All right, they're telling you to prepare for this. Fast forward 30 days, best January since 1987. I thought the numbers were bad. You just told me that 30 days ago that the numbers were so bad. So that's later that day, this could mean good things for the stock market in 2019. So this is what this causes. It just gets worse and worse. How are you supposed to invest following this? And so you read these headlines, and when you hear the best since 1987 or something, you're like, I'm in. And then you see turbulent and since Great Depression and all that, and then okay, I'm out. And this is what most investors do. And then you hear people say, I've never made money in the stock market. That's exactly why. That's exactly what they're doing.
Are you sure you didn't make all that up?
I didn't make it up.
That's crazy. So the next fiction that I wanted to talk about is that volatility has got to be feared. I mean, who wants to invest in something that behaves that erratically? I mean, nobody, right? I mean, we like our money just to be nice and stable and, all that kind of stuff. So that's the S&P 500, and it goes back about 40 years, goes back to March of '78 through the end of last year, and it's on a quarterly, viewpoint. And you go to the next slide, Dennis.
Sorry.
So the fiction is volatility needs to be feared. This slide really, I think, does a good job of highlighting that volatility and declines are really normal. And in 2018, like that first little picture that I showed, the volatility that we saw in 18 and even this year, up and down, is really to be expected. And what this slide does is it goes back over about the same period of time, and it shows the intra-year declines in the S&P 500, the U.S. stock market, each and every year. And so what you see is, and it's pretty interesting, you notice that like even this first year in 1980, there was an intra-year decline of negative 17%. There are some people that if they watch 17% of their hard-earned money disappear, and at the same time they looked on their phone and read some of those headlines that Dennis went over, like the numbers are horrible, stocks are going down and they're never coming back. And I actually think that's the time period, wasn't it, Dennis, where they had the headline, "The Death of Equities," the cover of Time magazine. But your portfolio goes down 17 and 18%, but the stock market ended in that 1980 of 26% to the upside. So you can see, and if you move along here, there is a fairly substantial decline. And what's really interesting is, and I don't want to make this all negative, but up here what it's saying is that there have been average annual declines of about 14% each and every year since 1980. It happens on an intra-year basis sometime during the year. The U.S. stock market, the large cap U.S. stock market, the biggest, most well-capitalized companies in America go down 14% on average about every year. So it's something I think to recognize that's just a fact. We ought to embrace that then, and we ought to plan ahead. Doesn't that make sense? Let's plan ahead, because that's going to happen, I think. That is probably going to continue. I don't know if it's going to be negative 13.9 or 14.5, but look, it's going to be, we're going to see a decline of, let's call it 10 to 15% about once a year. So we better have our financial plan match that. Is sort of the bottom line. Okay. You guys, everyone in the room, maybe not the new people in the room, but I'm the bad cop. Dennis is the good cop. He's nicer than me. I always get to spread the badness. So what this did is I went back a little bit further, and I went back to 1946, the year after World War II. So this covers 72 years of data here. So this covers basically the lifespan of every breathing human being in the room, or at least the adult lifespan of every breathing person in this room. And what it shows is, not surprisingly, we've seen declines of 10% or more, a total of 56 times out of these 72 years. Again, we need to plan for that. It happens about once a year. And it's nothing to freak out about. It's so important to keep our cool, and we're going to talk a little bit about that. But decline, and the story gets a lot worse, because the
headlines.
In our industry, what they call a bear market, which is a bad market, is a decline of 20%. And I mean, the good or the bad news is we just went through one in the fourth quarter of 2018. But this number doesn't really do it justice, because the average of these 15 bear markets that have happened going back to World War II is actually closer to the average decline on those. It's actually closer to 30%. So let that sink in just a little bit. I mean, what I'm saying is that you have been invited to put your hard-earned money into an investment that you're going to watch 30% of your capital disappear about every 5 years. I mean, why would anyone want to do that? So I can think of a couple of reasons, but one in a very simple manner. This is where the S&P 500 stood in 1946. And that one, Frank, is not a typo. It was at 8. You would think that it would be. It was at 18. And I don't know, things can happen quickly in the market, but it closed at 27.92 yesterday. Today it closed at 27.84, so right about there, right? And I haven't really done the math here, but if I take 27.92 divided by 18, I mean, that's 155 times. I mean, can you think about how your life would be if you had 155 times more money than what you have right now? Yeah, you wouldn't be here. Well, hopefully, would you be there? What if you had 155 times more husbands than you have? I mean, 155 times something is something. That's all I'm trying to say, okay? And since I'm standing here with Patty and Verlin Brewster, and they're laughing, I'm going to keep this up. Verlin and I, God love him, had a little email exchange. So here's another reason why I think it might be appropriate, even though it's painful from time to time, to allocate some of your money to scary stocks. And that is, Verlin pointed out to me yesterday, and I want to see really how many other people experience this. What I would like to ask you guys is, how many people drove to this meeting today? Hang on. I'm glad you drove, because that's part of what I'm asking. How many people drove here in a car that cost more than your first house? Come on. I mean, I see more than half the room. Your bank account's not going to solve that. Bonds are not going to solve that. Owning shares of the great companies in America and the world historically has solved that problem. So those are two really good reasons that I can think of to own these scary stocks, even though they go down, sometimes horrifically. Yes, sir.
Your point is well made, and I don't dispute that at all. But from your viewpoint, does the rate of volatility, does it seem to be increasing?
No. No, the volatility that we're seeing, at least this year, I mean, it certainly has been increasing from 17. There's no question about that. But the rate of volatility is about the same that it's been for, going back to World War II. Quite honestly. So, I mean, I know that's probably not the answer that you want to hear. It's pretty normal volatility, and it's really, and that kind of brings up something, and I know this is borderline unethical, but whatever. The more you look at your statement, the more you log in and look at your account, the less happy you'll be.
Oh no!
I promise you. I don't know why that's the truth, but I believe in my bones that that's the truth. The more often you look at your stock portfolio, the less happiness you will experience.
Have a good day.
I do love to look at it on a good day, but then the next day I get all deflated again, And that's something that really, there was a guy that I met in those travels looking for the really smart guy, and this guy since passed away and everything, and I don't know how smart, but he did say something to me that when he told me, and I was a young whippersnapper, I didn't really want to believe, but he's like, Brian, you got to come up with a strategy that works and is solid and all that. And let me tell you something. Don't ever get too full of yourself. Don't celebrate any victories in this business, and don't suffer any defeats. Just keep running your strategy. Whatever it is, run your strategy. Run your strategy. Run your strategy. Don't get real excited. Don't get depressed. Just keep, so.
All that looking, you found Dennis.
I know. And that's a whole nother story. That if you want to hear that story sometime, that's a pretty interesting story.
Oh, yeah.
Because that happened by accident, too. God works in mysterious ways, man. Okay, so Dennis is going to talk a little bit about how do we take some of the risk out of all that uncertainty and volatility and scariness and riskiness of stocks, because they are risky if you don't use them right, like many things.
Yeah, and Brian just talked about every year we have that volatility. It's about long-term, having the strategy, again, like I said, sticking to it and everything. This is how we do it. This is how we allow us and you to stick with the plan, stick with the strategy by allocating different buckets, different parts of your money in different buckets based on what you need when you need it. Some of you might be, if you're sitting at a table, 3 of you might be in 60% stocks. But every one of you, if you pull up your statement, is completely different. And it's because your buckets are different. Some of you might be taking out, this percent or this amount versus this amount. You all have different dollar amounts. You're withdrawing different amounts. Maybe you're not withdrawing yet. But what we're doing is, so everyone has their own unique, customized approach to where, like the first few years, that's cash and CDs and short-term bonds, because that's about the time of an average bear market that Brian just went through. We see those 20, 30% declines. That's about how long it takes before we see them come back. And so we've got that set aside there in cash and, again, maybe some short-term bonds. Then maybe the next 2 to 3 years are some, a little bit longer short-term bonds. Really high quality, safe. They're there if we need them. No stocks in it. All right. 4 to 6 years, it's your a little bit longer-term bonds. We're not going to need those for 4, 5, 6, 7 years. That's okay. 7 to 10 years, that's a mix usually of some bonds, and we start seeing some of the higher quality stocks in that bucket there. And then longer term bucket is that's all your stocks, 11 plus years. So I just wanted to go over a real life example, but we've gone over this with some of you, just kind of put some numbers to it on what I'm saying. So let's say if you come in with $1 million and we sit down and come up with a plan, and we're going to invest 60% stocks, 40% bonds for you, and you tell us, okay, here's my $1 million, we're retired now, I need $40,000 a year, I need that. We're a paycheck manufacturing firm, that's got to show up in my bank account every month. I need $40,000 a year to do what we want to do and pay our bills. So the first thing we do is we set up the portfolio like this. We're going to have about $40,000 in cash money market. It doesn't make, right now, hardly anything if that is not making anything. That's not the purpose of it, though. The purpose of it is to be able to send it to you when you need it, so we don't have to worry about where the stock market is today and next month and the month after. And then we've got about $384,000 in bonds. So if we're sending you $40,000 a year, that buys us another 9.5 years of income right there. So what we've done by doing that, if you can think about it this way, is we've got 10.5 years of your income need in cash and bonds, the safe stuff in your portfolio. And because of that, if we're sitting there and you're reading these headlines, or we're in this 10% decline, and we're saying it's temporary, but we don't need, and you don't need to worry about it, because the first time, worst case scenario, let's say it's a much, much longer bear market, and we're needing to tap into these bonds more than we ever have. We don't need to worry about where the stock market is till July of 2029. That's the first time we're ever going to be forced to sell a single share of stock. And I don't know where the stock market's going to be tomorrow or next month, but I'll make a bet with you where it's going to be 2029. And it's probably going to be higher than it is today. It always has been. A global stock portfolio over a 10.5 year time frame, it's always been higher. So it's just, you have a much higher probability of selling stocks when they're up. And this is simplified. What we're doing too is this portfolio is spitting off 20 or 30,000 a year in income and dividends. So that's going back and replenishing that. Or if we have, like this month, we saw that stocks are up 10, 15%. This 576 maybe goes up to 600, 610. We rebalance and take some chips off the table, and if this is down to 20, we're going to take that and put it back in there. And if we don't need to replenish a ton of it, we'll just go buy some more bonds, buy you more time. That way we've always got this time sitting there for you to where, when we're going through that, these terrible times, every year again, it's fallen 10 or 15%. It's okay. We don't need to sell them right now. We can have that long-term view because we're not going to need them till then.
Flip back, Dennis. Are there any questions at all about that? May be one of the more meaningful slides about really what we're doing behind the scenes. I know you guys don't see that, and a lot of people, sometimes don't even care as long as your income's showing up in the mailbox every month. But we're always mapping out that we've got years and years and years of the client's unmet income needs, and this is why it's so important that we stay in communication. It may not just be an income need. You may need to replace a car. You may need to help a kid or whatever. So as soon as we know those cash flow wants or needs, and we plug that in, and we've already got that squared away, no matter what happens in the stock or bond markets, hopefully you can see how that takes a lot of the risk out of owning. Because it's scary to watch these stocks bounce around a lot, especially when you're not putting any more money in it. So, good to go? Okay, so the fiction we were trying to address is that volatility must be feared. Is that really so if you've got a logical plan tied to your goals and your dreams and your dollars and your deadlines and your situation? Maybe we can kind of, quit looking at it. So, this is a viewpoint of the Standard & Poor's 500 going back the past 40 years, but it's looking at it in these, blocks of quarterly, every 90 days, every 90 days, every 90 days. So it looks really erratic. And so if we can, Dennis just bought us 10.5 years, but really it was a lot more if that client needs 40,000, because the portfolio is going to be throwing off. That portfolio is probably, 3.5%. There's another $28,000 a year, so it was a lot more time than that. And the idea is on the next slide.
Well, I want to point out too the question on is it more volatile lately? This answers it. Here's recently.
Yeah, that is.
And you look at the past. I mean, here's back in the 80s and 90s and 2000. I mean, we're nothing near what we've seen previously. So it's much less volatile right now. It's just we've gotten used to it. We've gotten used to less volatility, so when it happens, we're surprised.
So hopefully that when we are able to buy, when the clients can see, when we can see as an investor that we've got our living expenses covered, we've got our next car replacement covered, we've got our next dream trip paid for no matter what happens, then maybe we can take a longer view. And who wouldn't want to take that ride, right? I mean, that's the ride we want to take, right, y'all? I mean, it's, but that's the same investment. That's the same exact investment. That's the S&P 500. It goes over exactly the same period of time, the last 40 years. It's just looking at it with a longer point of view, and it makes all the difference in the world a lot of times, the way you perceive things, even if it's the same thing. You can have to see two people look at the same thing. Two people, it happens in car accidents all the time, where you got this witness saw that, but this other witness saw that. But it's how you perceive things, and that's what we're really trying to do, is help people understand that, hey, we got your short-term money set aside, and we got your midterm, and we even got that new idea you came up with. Let's square that away, and then you can kind of, then you can take that kind of a ride. Okay, so we've all heard this saying that it's almost, I feel a little bit silly to say it, except that I believe in it like 100%. And that is that it's not necessarily what happens to us that matters most. It's, you guys know this, it's how we react to it, right? So between the stimulus and response, we've got a choice, which is great, right? So what this is, again, this is the same investment. This is the Standard & Poor's 500 index.
What is that?
We're talking about the exact same investment. It goes over the exact same period of time, the past 40 years. Here's the difference between the blue and the orange. Is each one of these people put $10,000 into this back in 1977. And this blue person up here, that was this smart lady up here. And this kind of scared guy right here, okay? So we got the smart lady up here and the scared guy right here. And the smart lady, what she does is, anytime after she looks at all this, anytime that the market drops by 8% or more, she buys more shares of the great companies of America at a discounted price.
$2,000.
She puts $2,000 more into her account. Now the other person reads all those headlines that Dennis went over before. They're going down, they're never coming back, this is the worst we've ever seen, it's only going to get worse. And what they do is they take, every time the markets drop by 8% or more, they take $2,000 and they move it over to a cash account or a T-bill account. Okay? Or put it under the mattress, whatever you want to call it. And you can see it's the same facts, the same thing happened, and the way they reacted meant all the difference. Who would rather be in the blue area? Who would rather be the blue, and who would rather be the orange? I mean, the answer is very, very obvious when you look at it like that. Nonetheless, it is human nature. I mean, you've never said this to me, Patty, but I bet sometimes you're like, what's my dream team? What's my A team doing over there? Are they really? So I bet there's people in the room that when the market goes down, you're like, you know, are they doing their job? What's going on? You might even feel like you want to like get a brick and go throw it through our window over there at Quail Point Drive. Now what this data says is that what you really ought to do, go ahead, that's just human nature. Throw the brick through the window. But put a big check around it first, and then throw it through the window, and we'll get that into your account, and then you'll be more like this blue guy up here rather than the orange, okay?
Just don't throw it through my window. So the next fiction is market timing, and this is one you hear. I mean, we hear time it. What do you think is going to happen going forward, or are we, the headlines are saying that, like the one I said before, we're poised for a bear market. It's how to prepare for this stock market decline and everything. So, prepare for it. It's coming. Here we go. The fact is, you can't. I mean, and on the opposite, it happens when you least expect it. You think about last year. We had a bear market. We had historic low unemployment. The economy is doing pretty well. There's a lot of, someone shouldn't be putting stuff on Twitter, but besides that, if the president would stay off, that might help, but the economy's good. Unemployment's good. We were in a bear market. Think about 2009, we're coming out of the Great Recession. Unemployment was double what it is now. The economy wasn't doing well. It went up 23%. It was the beginning of one of the best bull markets we've seen. You can't predict it because it's looking forward, so it's really based on, okay, what's the expectation and is it meeting that or not? So this chart just shows really the danger in trying to predict it. So not only can you not predict when it's going to happen, but if you try, kind of if you think back to when I was talking about the headlines, and it was really bad, and we had the worst ever, it was the worst since December since Depression and all that, and then bam, 2 days it goes up 6%. So this kind of shows you, if you look back to 1990, if you put $1,000 in the S&P 500 and it opened up, kind of like Brian said, don't open your statement, don't look at it, and then you open it on the end of 2017, you had $13,739. So in that time frame from 1990 to 2017, there was over 7,000 trading days. It's a lot of days to trade on, to sit there and try to time it and get it out. If you missed the best 15 out of more than 7,000, your 13,000 is only 5,300. You missed about 65% of your return in 15 days. And here's the really bad news is, 25 it even drops. But here's what makes it even harder. When those best days happen. Half of them happen during a bear market. When the headlines are the worst, when the market's falling, kind of like that we just saw, is down, its worst since, then bam, it happens. The next 25%, 28, but roughly 25% are right at the beginning of a bull market, that first 2 months. So if you think about it, people are like, I'm going to get out. You hear someone say, oh, I got out. And, I missed that decline. But when do you get back in? Because if you wait 2 months into a bull market, you've missed 75% of the best days to be there. And kind of like if you think back to, like I just said, that 2 days went up 6%, and you think, I got out on Christmas Eve, it went up 6%. Well, I'll wait till it comes. Well, now it's up another 12%. Now you've missed 18%. Do you get back in now? Because then what if it falls down and you decline twice without an increase? So this just shows it's really dangerous to try to predict when it's going to happen and try to time the markets. It's really detrimental. So this is a good quote that kind of ties in along with that. Peter Lynch said, "I can't recall ever once having seen the name of a market timer on Forbes' annual list of the richest people in the world. If it were truly possible to predict corrections, you think somebody would have made billions by doing it." I mean, that's right, isn't it? And so for those of you who don't know, Peter Lynch was one of the most successful mutual fund managers. He was the fund manager of the Magellan Fund at Fidelity from 1977 to 1990. He averaged 29% a year return. He doubled the S&P during that time. I mean, I don't know about you, I'll take 29% a year. That'd be great, right? So Fidelity went back and did a study and looked at when everyone got in the fund and got out of the fund and did all the cash flows in and out. The average investor, now remind you, 29% a year over 13 years. That's things going way up. The average investor lost money in the fund. Most people lost money when it's going up 29% a year. Because when did they get in? They got in after the headlines were saying how great it was. And then when it went down, they got out. So it just shows you, again, we hear, I've never made money in the stock market. That's why. It's there. He offered you at 29, but you had to stay in it. And you got it.
Okay, we'll speed this along real quick. I know we're running up on the hour. We hear all the time, and I think everything else kind of leads into this. Let's invest in what's going up. And if you guys watch any of the financial news, they're always talking about, here's where we see the opportunity. Here's what's going up. People come up to me, here, what's going up? What should I put my money in? Or, what's going down? Think about that. Doesn't that also necessitate somebody that can predict the future? But wait, at the beginning of the meeting, remember we saw what was hot. It was Qatar. So why don't we go and take, I don't know. Are you game for 25% of your equities going to Qatar? I mean, Patty, wouldn't it make you feel secure to own like Qatar National Bank and, I don't know, Barwa Real Estate, or how about this one, Ooredoo Communications? Of course not. That wouldn't be prudent. That would be speculating. We don't have the right to gamble with y'all's hard-earned money. I mean, but you see it every day, though. You see these guys like on CNBC, they'll throw up a chart, and they sound real smart, and they're going to be going, this is where our firm see this trend, and they're like, we got all our clients in right here, and they've enjoyed this great ride, and we see this continuing. No, they don't. They don't know. I mean, they don't know. So, instead.
Well, guess what that's done this year? Down 1%. Under everything. And this has kind of reminded us of this. To kind of put that in a real world deal. You're over in the left lane, right? And the right lane's just going and going and going and going. You're like, I'm going to get in this lane. Someone finally, they're staring at their phone, so you jump in front of them real quick because they're not paying attention. What happens immediately after that? The lane you're in starts going, right? So that's kind of like talking about before. Now you're sitting there going, oh. Now you're mad, you're anxious, you just took a chance to have an accident. Now do you stay there or do you get back in the other lane again? Because what's going to happen if you get back in the other lane? It's going to happen to you all over again, right? So that's kind of the same thing. So it kind of gets into, this is how, this is in, I think it's page 10 and 11 of your investment philosophy brochure, but so this is how we're investing your money. Instead of doing that, trying to chase what's hot, we're putting it in all these different asset classes, diversifying it across all those stocks I went over earlier. And up top here, these are the best ones, year by year, back to 2013. Small cap was at 48%, and then mid cap. And so instead of saying, okay, well, small cap was way up, let's put all the money in that. We've talked about this before, but what we're doing, we're rebalancing and taking those gains and putting them in things that didn't do as well. And here's why, because if you look over this time frame from 2003 to 2017, only one time did an asset class repeat itself and was the top performer again the next year. And then you kind of look at the next, 3 of the next 5 years, it was towards the bottom after that. So instead of chasing what's going up, even though it's a big asset class,
What's going up?
yeah, it's going up, but it just never repeats itself. Besides that one time, and it just. So we're just rebalancing and taking our gains and putting them back in your bucket number 1 or bucket number 2, and saying thanks. We'll take that 48% and we'll make sure you get that income next year. All right, it's not as exciting, but this is what's provided the returns we've done. So to kind of, if you take all those asset classes, and this just shows you in 1970, if you just invest globally like it is now, versus if you just put it in bonds and left it alone, you didn't have to put up all that volatility that Brian was talking about, the 10% or 14% every year, and 20-30% every 5 years. You went from $1 to $9, from $9 to 1970 to 2017. You made $8. If you put it in the S&P 500, that went up to $122, which isn't bad. But if you just invest globally, and you're having all these different asset classes, and just stick with the plan, it's $477 at the end. There's more volatility in it versus the bonds, but who would rather have 477 versus 9? And it kind of goes back to that's why we put up, that's why you as an investor, that's why you've got to put up with that, average of every year of seeing your stocks go down 15%.
Why don't you just fast forward to the Harry Vardon quote? I don't know if you guys, Harry Vardon was like one of the best golfers in the world. I understand, I'm not a golfer. If you ever see him on the golf course, you should run. I mean, it's bad. But Harry Vardon, I guess, was one of the best golfers that ever lived. There's a movie that I would highly recommend if you haven't seen it. It's called The Greatest Game Ever Played. And there was a kid named Francis Ouimet, 20 years old, and he won the U.S. Open, and he beat Harry Vardon. And it's an incredible movie. For the guys in the room, if you rent the movie and you cry, don't blame me. I don't care whether you're a guy or a girl. If you rent the movie and you don't cry, I'd go get your blood pressure checked somewhere. But I think Harry's quote here just sums up really everything about the message that we're trying to get across. There are only two types of players: those who keep their nerves under control and win championships, and those who don't. So anyway, I hope our talk today has been on point and enlightening and helpful. And with that, I just want to thank all you guys for being here today. And Chris, thank you so much for manning the cameras until now. And we'll go into Q&A for, I'm just going to yield the floor to you guys for any questions.